Hello, welcome to this week's ITPM Flash. My name's Ed Shek. It's a pleasure to be here. And as earnings season gets underway, I wanted to come and look at the current market setup from a valuation and earnings perspective. And I'm going to come at this from an equity risk premium perspective. Now, equity risk premium is an essential part of the capital assets pricing model. And it's there to calculate the cost of capital, stroke equity, and calculate the required rate of return for equity or stakeholders. Now, within our world, we simply think of the equity risk premium as the excess return required over fixed income to take on the extra inherent risk of owning equities over the risk-free rate. Now, the equity risk premium as a calculation is the expected return minus the risk-free rate. And there are various versions. The most simplistic one is looking as the equity risk premium as an earnings yield minus the risk-free rate. Some publications will show an earnings yield plus dividend yield as the expected return. Neither of these are strictly speaking true. It's quite a complicated calculation. The true equity risk premium. However, today's not about calculating the exact number to 2 decimal places. Like everything, it's about understanding the current range within its historical context and then decide whether or not the equity risk premium is giving a good risk reward for equity holders today. So we're going to use the simplified earnings yield. And if we think of the index level, this is just EPS over the index level. Okay, so if we take the SPX, we've got expected earnings full year of about $214. Using the level at 4388 at the moment will give you an earnings yield of just under 5%. And of course, you can get the earnings yield just by taking the inverse of the PE ratio, and Refinitiv have, I think, trailing PE at 20.5 and forward at just under 20. So we can safely say that the SPX has got an earnings yield of about 5%. And then, of course, look at the 10-year yield. It's 4.06 at the moment. And you're getting an equity risk premium of around 1. Okay? Obviously, if you put dividend yield in at 1.7, you just shift the chart up the y-axis. But anyway, let's have a look at the chart now and see what it looks like. So at first blush, it just looks like it's at historically very, very low levels, which of course it is. And part of the reason of talking about this today is very easy to say, well, this just means equities are expensive and the market's going to go down. But of course, it's never that simple. And as an aside, when you're trying to develop your macro view, your bullish or bearish bias, you can't just cherry pick a couple of charts and think that's job done. It's obviously combining a lot of charts like this, understanding what's moving each and bringing them all together to try and hopefully find a coherent bias. But further analysis of this chart, when we really take a step back and think for 5 minutes, we'll realize that the 7 hyperscaler tech stocks have had a huge rally over the last few months, way in excess of their earnings trajectories, which of course means the P multiples expanded, which of course drives down the equity risk premium. What we can say is that the ERP is at a historically very low level. Okay? What does that mean? Is it good or bad? Well, again, it's never that simple, but let's have a look at a few interpretations. Now, the first one, which isn't relevant to today's market, but I'll mention it briefly, is if risk-free rate's very low. So if the risk-free rate's very low, asset allocators may decide that they're happy to forgo that very low number and they're going to chase risk assets to get a better yield. And of course, this is what's happened, or part of the reason why equities and risk assets have rallied so much through QE. Your risk-free rate's so low, you bid up equities, P's expand, equity risk premiums go down. So that's easy to understand, but clearly not relevant today. The risk-free rate is higher. We've had a big tightening cycle. Financial repression is reducing, arguably coming to an end. So that doesn't really explain the low equity risk premium today. The second interpretation is that investors are just very, very confident of the earnings picture. And therefore, although the equity risk premium is low, they feel very confident that they're going to get it, and you've got a higher probability of a lower excess return. So that stands. This also dovetails into reason 3. You think expected returns going forward are going to be less than the ones just witnessed. Okay? So they're priced in a lot of good news. Expected returns are still going to give you a small excess over the risk-free rate, but things have obviously caught up and arguably are slightly ahead of where the earnings cycle is. And of course, the fourth interpretation is that equities are just too expensive from a risk-reward perspective, the bearish case. Now, let's put a chart of the SPX over the equity risk premium, and this is what we get. So what does this tell us? Well, I'll say it once more. One chart doesn't tell you everything you're going to need. So we're going to try and avoid just saying, right, the market's got to go down because the equity risk premium is low. And when you look at the rally through the middle of the chart in the SPX, you can see that the market can happily rally with equity risk premiums in the 3 to 4.5 range, which historically over this chart's duration is the average. But what we can say is when equity risk premiums rally off this low levels, it's highly likely the market will be going down. But of course, equity risk premium is inextricably linked to earnings, so that's almost a truism. So we've got to bring in the earnings picture now, right? And see what the market setup is. Now, all this bar chart shows is the quarter-on-quarter change in aggregate earnings. And we've also got to think what the market was thinking and set up during each of these earnings periods. So in Q4 2022, market set up bearishly, heavily short, the recession's coming, earnings recession really starting to hit. Earnings came in down nearly 5%. It was better than expected. Market rallies. Then last quarter earnings, market interpretation, bearish. It's got to hit now. Consumer can't hold everything up forever. And of course, earnings came in only down 2%. And then the pain trade really started. Now, this quarter about to get underway is the nadir of quarter-on-quarter declines, according to the analysts, down 6.4%. But of course, as we come into this quarter, markets had a big old pain trade rally. And in the face of declining earnings, the P's expanded from 15 to 20. Because stocks have gone up, earnings are still coming down for the quarter, P's expand. But when we look forward now, we're expecting earnings to be slightly higher next quarter, and then we have a big old rally in Q4, up 8%. This is going to require margins almost getting back to the cycle highs when the markets were high. So there's a lot of good news baked into the market at the moment, and expectations for a rapid half-2 earnings recovery are very much in place. And then when you put it in this context, if we get the Q4 rally, aggregate earnings are only going to be down 2% this year. We will be towards the end of the tightening cycle. And then we just get a nice big, no recession, cyclical recovery in 24 and 25. And that's obviously going to require Europe to come out of its recession with France, Germany and the UK, and China to sort itself out and start growing again. So what are the observations and conclusions? Well, low VIX and low equity risk premium does indicate a certain amount of optimism / complacency in the market. The PE expansion through the last quarter into the face of falling earnings really says that the market's not worried and it's all going to improve from here going on. Now, these are quite big assumptions, right? And when we look at the equity risk premium, we have to conclude that there is a fair risk of downside if earnings don't come through, okay? I don't think earnings meeting is going to be enough for a decent continuation of this rally. And I think the risk to disappointing to the downside is much greater than earnings are okay, a little bit better, and then expect a big rally. So the final conclusion, as always, is all roads lead to being long short, equity options if possible, equities otherwise. Earnings season's going to be big, right? You need a lot of actionable watch trades ready, have to be really nimble. There could be some great opportunities to the downside if earnings start to disappoint. And you know it's because of the low equity risk premium, very low VIX, and a lot of optimism and good news already priced into the markets. So it's a really good earnings season coming up. It's a great opportunity. Don't have too much of a bias going in would be my advice, but get ready to change the bias when the data, not the stories, start to change. Good trading. See you in a month. Bye-bye.